In the grand theater of modern equity markets, certain companies defy every logic investors hold dear. Cheer. Cheer Holding Inc., ticker symbol CHR, is one such enigma, a company with a balance sheet that seems almost implausible. As of late 2025, this Beijing-based media and technology firm reported holding about $200 million in cash and carrying less than $10 million in total debt. Yet its entire market capitalization hovered near $2 million, and its stock traded below 20 cents. That means the market values every dollar of its cash at less than a penny. Normally, such a discrepancy would ignite a rush of value investors eager to arbitrage the spread between intrinsic worth and market price. But here, there is no rush, only silence. That silence is not ignorance, it's doubt. A market this skeptical is sending a message. The problem is not the numbers, but the trust behind them. And before we dive deeper into why, for those watching this as a short, you can click the full version link below to hear the complete story without interruption. Cheer Holding began in 2016 as Glory Star New Media Group Holdings, born into the rapid expansion of China's mobile internet boom. It built its business on a clear thesis: monetize digital engagement. Through the Cheers app, a hybrid platform combining short-form video, advertising, and e-commerce, it aimed to connect brands and consumers in a closed-loop ecosystem. For a few years, it worked. Revenues grew well past $100 million, profits turned positive, and the company earned a Nasdaq listing, a rare feat for a mid-tier Chinese digital firm. Investors viewed it as a small but credible play on China's digital advertising market, an alternative to the tech giants dominating the sector. But at around 2023, the story began to twist. The company changed its name to Cheer Holding Inc., and in November of that year completed a 1-for-10 reverse stock split. Reverse splits are typically a regulatory maneuver, a way to raise a stock's per-share price to avoid delisting for trading under $1. Under normal circumstances, such a move is accompanied by an operational improvement plan or a refreshed growth narrative to signal recovery. In Cheer's case, there was none. The split arrived abruptly, without a new strategy or financial catalyst. To many investors, that absence of context suggested management was buying time, not confidence. Then came a bold pivot. In early 2024, Cheer announced a transformation into an AI-driven media enterprise. It launched the Telepathy AI project, promising to weave artificial intelligence into content creation, advertising analytics, and user engagement. Conceptually, the move aligned with global trends. By 2024, most digital platforms were embracing AI integration to sustain relevance. But in timing and execution, it was unusual. Successful companies typically pivot to new technologies from a position of strength after securing stable revenue streams. Cheer did the opposite. It announced reinvention amid declining performance. In financial storytelling, that is a red flag. Innovation without stability often reads as desperation. The numbers soon validated investor unease. In March 2025, Cheer reported its full year 2024 results. About $147 million in revenue and $26 million in net income, both lower than the prior year. Then, in August 2025, came an event few investors ever want to see: a financial restatement. The company revised its first half figures downward, revealing $71 million in revenue and $8 million in profit. Restatements are not standard procedure. In normal corporate governance, they occur only under auditor intervention or regulatory requirement, and are accompanied by detailed disclosures explaining the cause. When they appear without full transparency, they imply internal control weaknesses, potential misclassifications, or incomplete oversight. For investors, such uncertainty is poison. It transforms spreadsheets from evidence into speculation. By October 2025, the narrative shifted from concern to crisis. On October 2nd, Cheer announced an $8.5 million capital raise through a direct offering of roughly 12 million units, each including either a share or a pre-funded warrant paired with 2 additional warrants. This structure, multi-layered with A and B series warrants, is atypical for a firm claiming $200 million in cash. Ordinarily, companies in strong liquidity positions issue equity at favorable prices or use debt instruments for precision funding. The use of such a dilutive, warrant-heavy structure at a depressed share price suggested either restricted access to their own cash or preparation for future capital shortfalls. The market read the signal clearly. Liquidity on paper might not equal liquidity in practice. 2 weeks later, on October 16, 2025, Nasdaq sent Cheer a formal notice of non-compliance with Listing Rule 5550A2 for trading below $1. Under standard Nasdaq policy, companies receive a 180-day grace period, in this case until April 14, 2026, to cure the deficiency. Typically, firms in this position respond immediately with a corrective plan, announcing intentions for another reverse split or disclosing actions to boost market confidence. Cheer did not. The absence of any immediate communication was striking. Silence in moments demanding reassurance is rarely benign. It suggested either managerial paralysis or a lack of viable solutions. For investors, that silence was louder than any disclosure. In an attempt to reassert momentum, management released Telepathy AI 3.0 on October 28, 2025, highlighting new portrait generation functions and deeper integration of AI tools across the Cheers ecosystem. The announcement triggered a sharp intraday rally. The stock spiked from about 13 cents to above 30 before closing back below 20. This kind of short-lived volatility is typical of microcaps chasing sentiment. Prices soar on hype and collapse when fundamentals fail to follow through. In healthy companies, product launches supported by measurable adoption sustain the price. Here, the move lasted hours, not days, a symptom of hope unsupported by substance. Technically, the chart tells a grim story. The 50-day moving average sits near 47 cents and the 200-day average near $1.35. Both well above the current price. That configuration, price below both key averages, confirms a prolonged bearish trend. The relative strength index around 51 indicates neutrality, not oversold enough for a technical rebound, not strong enough for sustained buying. In a typical scenario, a profitable, cash-rich firm trading at these levels would attract value investors. That it hasn't speaks volumes. It means the market has stopped believing its own data. This disbelief is magnified by the numbers themselves. On paper, Cheer is absurdly undervalued. $200 million in cash, less than $10 million in debt, a price-to-earnings ratio of roughly 0.07, and a price-to-sales ratio near 0.01. In ordinary conditions, those figures would imply a deep value opportunity. But in the market's eyes, such extreme undervaluation signals opacity, uncertainty about whether the assets exist, are accessible, or are accurately reported. Compounding that risk, over 90% of the company's revenue derives from the Cheers app, leaving its income stream dangerously concentrated. One platform failure, regulatory challenge, or market disruption could collapse its entire operating base. The story of Cheer Holding unfolds in 3 acts. The first was belief, a young, fast-moving firm riding the digital advertising wave. The second was disillusion, the unraveling of that belief through corrections, dilutions, and compliance failures. The third, now in progress, is ambiguity, a limbo in which numbers suggest strength, but credibility suggests fragility. This ambiguity carries profound implications. Markets are not mechanical calculators, they are trust economies. Investors trade belief as much as they trade earnings. Once belief breaks, capital flees, and rebuilding it becomes exponentially harder. Cheers' case demonstrates how financial value decouples from numerical value when transparency falters. The market is no longer pricing its cash or profits, it is pricing its governance risk. What then can investors infer from this pattern? In the short term, CHR represents a volatility-driven opportunity rather than a fundamental investment. Realistic entry levels sit between 10 and 20 cents, with speculative rebounds possible toward 47 to 60 cents if momentum reappears. However, prudent risk control, such as stop-loss orders below 8 cents, is essential. In the medium term, recovery depends on 2 concrete achievements: restoring Nasdaq compliance and demonstrating that the October capital raise stabilized operations. Success could lift the price towards 60 cents to $1 over 6 to 12 months. Failure could trap it between 5 and 20 cents indefinitely. Long-term outcomes hinge entirely on execution and credibility. If management converts its $200 million in cash into tangible, diversified growth and proves that the reported balance sheet reflects reality, the stock could rise above $1 and potentially approach $2. But if governance concerns persist and transparency remains elusive, the downside is terminal: delisting, illiquidity, and value erosion. Shareholdings saga is not merely about financial misalignment, it is about the anatomy of broken trust in the information age. It teaches that markets no longer reward cash, profit, or technology in isolation. They reward coherence, consistency, and credibility. Every irregular event in this narrative, the unaccompanied reverse split, the mid-decline AI pivot, the unexplained restatement, the dilutive raise despite reported liquidity, and the silence after Nasdaq's warning, deviates from standard corporate behavior. Each deviation whispers the same warning. The issue is not solvency, but sincerity. To all our listeners and viewers who continue to follow these deep dive analyses, your time, your comments, your likes, and the way you share these stories beyond this platform are what keep this work alive. Thank you for your support. We'll continue striving to deliver even more insightful and truthful content that helps you navigate markets with clarity. This was ValueStir.